Hi, everyone. Thank you for joining us today. I'm Marcia Butler, the webinar director here at Advice Chaser. Before we introduce our guest and get started, I do need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions and make comments using the chat box. And the presenter will answer those queries during or after the webinar today as appropriate. If you ask a question in the chat box, go ahead and leave your phone number as well. And if we can't get to your question during the event, we'll make sure someone reaches out to you after today's event. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material, and that is in your chat box. I'd love to introduce you to our presenter today. Jeffrey Costa is a portfolio manager and certified financial planner who crafts comprehensive financial plans and investment strategies for his clients. Jeff joined Schultz & Company in 2020. He specializes in holistic financial planning, as well as managing his clients' portfolios to meet their short-term and long-term goals. Prior to Schultz & Company, Jeffrey worked at First County Advisors as a trust and investment officer for 4 years. He began his career in financial services as a financial planner and investment advisor representative at Barnum Financial Group, an office of MetLife, in 2009. He has taught on-site financial education in multiple Fortune 500 companies as part of MetLife's Plan Smart program. Jeffrey holds a BA in economics and political science from the University of Connecticut, and he has been a certified financial planner since 2017. Well, Jeff, I'm so excited to have you here. We've done quite a bit of preparation for this, and we're excited to help people learn a little bit about what you should do year-end financial-wise to be ready for the end of the year.
Thank you so much, Marcia. I appreciate it. I'm glad to be with everybody today. The goal here is to give you some easy tips to get yourself in a good position before the end of the year and into the next year. We have some things that I think will help people both save on taxes, get their investment portfolios in good shape, and also perhaps pick up some extra money by reallocating some of our savings and just kind of getting our house in order in general. So with that, we'll kick it off. So the first thing I kind of want to go through here is that as we head into the end of the year, we often set our 401k allocations earlier in the prior year, or maybe in 2 years ago or 3 years ago when we first start our job. And oftentimes we forget to revisit that. And so a good idea is to take a look at where your contribution levels are set. Make sure that it's in line with what you think you should be saving, what you can afford to be saving. And also from a tax saving standpoint, for many people, this is one of the key deductions that they get, particularly in this environment where the standard deduction is so high. So making sure that you max out on that allowance to save into your retirement plan is key when it comes to trying to reduce our tax liability. So for people that are under 50, there's one particular amount which has gone up significantly over the last few years and is about the 20,000 range or so. And as we are over 50, we can add a bit more by way of the catch-up contributions. So it's really a good opportunity to make sure that you log into your plan. It may be a while since you've been in there. For a lot of people, they've tried to do the ostrich head in the sand so they don't have to look at their 401k balance this year. But I urge you to do so, even if you're a little bit scared of the performance numbers. It's good to check your contribution numbers, as we want to make sure that you're allocated as you should be. With respect to the underlying investments, that's another piece of the pie that we need to make sure that we address, as markets have been a bit volatile the last year or two, to say the least. And we want to confirm that it's lining up with our risk tolerance. So if you're a pretty aggressive investor, you may want to stay, pretty heavy equities. You may want to revisit those allocations as it relates to kind of large cap, mid cap, small cap, international, all of those different types of funds, as well as revisiting the fixed income side of the house as well, as the interest rate environment has changed, as we'll talk a little bit more about in a couple slides. But making sure we're really aligned with how we can handle risk long term. Again, these are long-term accounts, so we don't necessarily want to have knee-jerk reactions on our allocations. It does give us a good opportunity to dollar cost average in while the market's low, some of these accounts, which is always painful at the time, but when you look back, it's generally a good opportunity. You're happy that you had done so. The last piece I want to spend a couple seconds on was Roth 401k option. Now, not all employers offer a Roth 401k option. And for those of you who maybe are a bit familiar with Roth, but maybe not totally clear on the difference between a traditional 401k or a traditional IRA versus a Roth, the key difference is how the money is treated on the way in. So in a traditional 401k, you get a tax deduction on the way in. So contributions are not taxed, they're deferred until a later date when you take the money out of those plans, and the government taxes you as ordinary income on the way out. In a Roth, either 401k or IRA, you pay the tax up front, you never pay the tax again. So as the funds grow, there's no taxes due. As the funds come out, you've already paid the tax man, and what you see in that balance is your money, which is definitely something that is a nice differentiator, because everybody feels good when they look at their 401k, but then they realize the government has about a 30% claim on the other on a chunk of that money. It feels less great. So with anything in life, it's good to diversify, and I usually tell my clients that it's great to have money in different types of buckets. So oftentimes for younger clients, they tend to be more heavy on the Roth side of the house because they're in a lower tax rate, tax rate compared to where they may be in the future based on their earnings potential as they go farther into their career. And for a lot of individuals, though, even if they're in a higher tax bracket and they want to get money into a Roth type bucket, they may be above the income limits to do a Roth IRA. So a Roth 401k, which doesn't have income limits, may offer an option to maybe take, even if you do 10 or 25% of your overall contributions to your retirement plan into a Roth, it can provide that opportunity to get money into that bucket. And again, it's not something that you have to do every year. If you think your income might be a little lower, say this year versus next, you can be tactical about how you decide to adjust those contributions, because you can change them throughout the year. So you're not stuck with your decision, once you do make that. So
we've got a really good question in here.
Oh, sure.
And also I wanted to ask another one as well. So with those Roth 401ks, I know that there's typically an employer match. Can you talk a little bit about the tax that happens on the matching dollars?
So typically what you see is that the match that you receive ends up always going to pre-tax contributions. And that's due to the way that the employer gets their tax benefit. So even if you do a Roth contribution on the employee part of that, you usually end up with your match heading into the pre-tax bucket. You know, still better than no match for sure, but they don't match just, you know, to the same type of bucket. It's usually predetermined.
All right, I'm going to go ahead and ask this question, and I'm going to phrase it maybe a little more succinctly than this person put it in, just for brevity's sake.
Sure.
So let's say that you were a W-2 employee and you had a 401k and you switched to being an independent contractor. Obviously, you would still have that 401k. It's no longer, deducted from your paycheck, but what are your thoughts about continuing to contribute to that 401k account, or opening up a new account and consolidating it, or maybe a hybrid of the two? Maybe you can talk about that situation.
Sure. So if you are no longer with that employer, you can no longer contribute to that 401k plan because it's matched to your old employer, and it all comes via payroll deduction. So the only option you would have for new contributions to a 401k would be if you were no longer just a contractor and now you worked for a new employer and you wanted to, in order to consolidate them, a lot of 401k plans allow you to roll directly from an old 401k into your new 401k and do it that way. And then you'd be able to just contribute to that one plan. There are certainly some pros and cons with moving your old 401k into your new 401k. Oftentimes, I recommend that my clients do an IRA because you have more control, and it's not like you're getting extra matching or anything by moving your 401k into that plan. Because once you're in that 401k plan, it's now subject to the same rules as far as withdrawals or kind of rollover that it would be, as any new contributions would be. So it's not delineated that, you can't say, oh, I want to move, the money I rolled in from my old company to an IRA now. It's not treated that way. So IRAs offer a lot more flexibility when it comes to your underlying investment choices, because you're not just governed by, say the 10 or 20 funds that your employer selects as part of that plan. In an IRA, you can pretty much buy whatever you want. If it's in a Schwab or Fidelity or whoever it might be, online brokerage, Schultz and Company, whoever, depending on how that account is governed, you have all kinds of different investment options, ETFs, mutual funds, individual stocks, versus in 401k plans, they're really just governed by a small subset of mutual funds or ETFs.
Okay, so from what I understand here, and I will say to this person who's asked the question, by the way, great question. If we didn't answer that,
it's a very common question.
Put some more information there. It sounds like they don't have another 401k type job. They're an independent contractor working for themselves. So, so you're saying that an IRA would be an option.
Yes.
And I'm assuming that because it's a traditional type of account, they would need to have a traditional IRA as opposed to a Roth IRA.
Unless they were ultimately electing to do a Roth conversion, in which case they would have a tax liability on that conversion amount. So that's something that you would want to review with typically with a tax professional, just to make sure that you understand the implications of that, because there certainly can be oftentimes, like if you're in between jobs and maybe your income is expected to dip, it might be a good time to do a Roth conversion because you're in a lower tax bracket, perhaps. For married individuals, there may not be as much of a difference depending if their spouse is working. I mean, there's a lot of variables there, but there are certainly some planning opportunities that go along with it. Also, types of accounts that individuals who are self-employed would typically look at. SEP IRAs are generally the most common now, as they offer the ability to put larger contributions than a traditional IRA. and have much higher thresholds. And that's something, the amount is determined by, once you have your income for the year that you show on your returns, your accountant will tell you what the applicable amount that you can contribute, the maximum there. So a little bit more complicated, but generally speaking, the investment options, the underlying fees are pretty much the same as a traditional IRA.
All right. We did have a couple more questions about
Sure.
IRAs. So
it's a hot topic.
And it's a good topic because it's important. So can anyone contribute to a Roth 401k? And you did mention income limits. Can you talk about the different types of Roth?
Sure. So the Roth 401k does not have an income exclusion. So any employee can contribute to that. The key piece of who is eligible or not is really whether your employer offers that option in your plan. They've become much more common, but not every plan offers it. So if your company's plan doesn't offer it, that's something that you may want to mention to your HR department as a potential add-on for plan. I mean, it's something that is, though, much more common because so many people are not able to contribute to a Roth IRA. So employers have started to kind of get wise to that and say, well, maybe we can offer this as a benefit because it doesn't really cost them anything. The only thing for them is that it adds a little bit more complexity to payroll because you have some deductions that are going pre-tax versus post-tax. But that's really, it's just the record keeping on their end.
All right. And then one final question before we move on to another topic here. Can you talk about options for small business owners? And maybe if you can talk a little bit about if you're a single person, kind of sole proprietor versus someone who has an employee or a couple of employees, or even just, 50 to 100 employees. I know there's lots of different options for business owners. There
are. I mean, we could spend probably a whole hour just on that. But I would say there's, the simple 401k plans that have, those are available for 50 to 100. A traditional 401k is probably the way you would go. There's different ERISA rules that you're subject to. And I would highly encourage any business owners that are thinking about setting up a plan to talk with someone who is a retirement plan specialist, because what they'll do is say, okay, you have a certain, they'll do similar to almost like a health insurance situation where they'll get the employee survey, how many employees you have, what their income is, how much you think they'll likely contribute, and they'll match a plan based on that to kind of fit the bill. But I would say the most common are kind of the traditional 401k plans, simple plans. And for small business, there are some opportunities where a SEP might make sense. More rarely now because of the higher the higher contribution amounts needed are like defined benefit plans. So most smaller employers are not doing pension plans. But there are some opportunities for employers who are like professional groups, like doctors' offices, where you're a sole prop doctor, maybe has one other partner. You might be a small group or an individual group where maybe the doctor and his wife may work in the practice. They're able to shove a bunch of money into a defined benefit plan and really defer tax on a lot of income doing it that way, because in order to set up a pension, you just set aside a lot of money. So it allows them to kind of to really pre-fund that ahead of time. So there's different creative ways to do that. But again, it's really a very specific type of offering. And it makes sense to really explore that with somebody who's in that space and can run your group of employees through it and expected contributions and so on.
Well, and at the end of the year, you do know your numbers for that year. So it's a good time to evaluate.
Yes.
And even if you're not changing it right now, it's a good time to evaluate.
Yes.
Are we in the right place?
Yes. And with different types of plans too, there are different deadlines to when you can make contributions. So for 401k plans, all money has to be in by the end of the year, calendar year. Whereas like a SEP and traditional IRAs, it's up until you file taxes. So you have that opportunity to like make that decision a little later and have contributions for the year prior. So again, there's lots of little nuances there that can be beneficial as you explore that.
I was going to ask about that. I'm glad you mentioned it.
Yeah.
All right. Well, we probably have a couple more questions that we're going to revisit this topic at the end during our question and answer session. But I'm just going to go ahead and move on, and then I'll keep tab of those questions and we'll revisit it at the end here.
Okay. All right. So for many individuals now that are in high deductible health plans, they may have access to a health savings account or a flexible savings account for health. You usually have one or the other, not both. But you may also have the opportunity to have a dependent care flexible savings account. And just high level, the difference between an HSA and an FSA, a lot of it comes down to the ability to roll it from one year to the next versus having to use it during that particular year. So a health savings account, which a lot of people kind of refer to it as a healthcare IRA, those contributions, whatever you don't use up to that maximum annual contribution, there's an individual limit, there's a family limit. Those can be rolled from one year to the next, any unused monies. And when you have an HSA, oftentimes there are different investment options for once you're over a certain threshold of funds in the account. So your HSA provider may say, okay, we need to keep at least 1,000 or 2,000 in kind of the money market, if you will, so that when we have reimbursements, they'll just come out of there almost like a checking account. But anything over that amount can be put into a variety of investment options, so you can actually grow your healthcare account, which is actually a really good planning tool long term. And so these are accounts, both types, that'll reduce your tax liability for the current year and could potentially help keep your taxes lower in the future. But for a flexible savings account, whether it's a healthcare flexible savings account or a dependent care savings account, those contributions and those monies in the accounts need to be utilized for that current year. And any money that's in there that's left over gets lost. It goes away. So it's really important to understand what your contribution is to that, and make sure that if you're going to contribute a certain amount, you also have the corresponding expenses that you have there. A perfect example on the flexible spending account, as the parent of 2 small children and paying a lot of money in daycare costs, the annual limit is $5,000 for a dependent care savings for a family, which anybody who pays daycare knows that that's like maybe a couple months worth of expenses. So you'll use that, and so that's something where you put the money in, you get a $5,000 tax deduction, and once you get the bill for those things and you pay them, you can just put in a claim to the provider, you submit a receipt, and then they'll just send you a check back. So you get the deduction, you get your money back, and you go on that way. For health savings account and for a health-related flexible spending account, the reimbursement is the same kind of thing. You have to submit your expenses. Your provider will let you know whether or not they are qualified, and they'll cut you the check back for those things as well. But it's important to make sure that you maximize your contribution so you get the deduction, because again, especially with the health savings account where you can roll it over from one year to the next, if you have maybe a big procedure coming up in the next couple of years, like perfect example is for younger people, if you're planning on maybe having a child and you have a high deductible plan, see what the deductible is maybe for birth, and save some extra funds there. Or if you're going to have a certain surgery coming up, elective procedures can qualify depending on what they are and everything. So there's a lot of reasons to make sure that you're kind of plan ahead for that and take advantage of the tax piece there. But again, for things you've already spent money on, there's an eligible window that you have to submit your reimbursement by. Typically, it's like a quarter beyond when the plan year ends. So it's always like a calendar year because it's a tax related item. So typically plans will allow you till like the end of March or so on to reimburse, to submit receipts and get reimbursement for that stuff. So just a good idea not to lose sight of it. And again, if you're for the dependent care, you've probably paid enough already the year. You don't have to wait till the end of the year. You could take January and February if you haven't done so and probably cover it.
We did have a question.
Sure.
Are there any options for FSA or HSA accounts for those individuals who don't have one linked to their health insurance plan?
So you have to, so for an HSA, if you have a high deductible plan, if it's an individual plan, but it is a high deductible plan and it meets the definition, because there are certain criteria you have to confirm that it is, qualified as that. There are options to open HSAs with third-party providers that you don't have to be as part of an employer group. For FSAs, I'm not 100% sure if you can do FSAs. That's something that I would confirm. I think you can probably figure that out pretty easily if you look it up. I've only ever really seen them in a group marketplace, though.
All right.
And quite frankly, from a health standpoint, the HSA is probably the better bet because you can roll it from one year to the next, and you can grow that money in an investment account, even if it's in a short-term bond fund. It doesn't have to be aggressive, but if you can earn 4% in the current environment, not a bad place to stash a little bit of money that you'll, given the health costs these days, you're likely to use it. So a good place to put some money.
I do know, and I will say this to our attendees: if you're interested in more about HSAs, we have done a couple webinars about HSAs, and you're welcome to view those webinars. Okay, moving on.
Okay, so as we get very close to the year end here, it's always a good time to take a quick look at your year-to-date pay stubs for both you and if you're married, a spouse, to get a sense of where your income is likely to end up for the year. Take a look at what your tax withholding is. And if you do your own taxes, you probably have a sense of what your average tax rate was for years prior. And you'll be able to get a sense of, based on your deductions, if you're in a similar boat as where you've been in years past, if you may owe or not. Some tax softwares allow you the ability to kind of pre-fill some numbers ahead of time, but oftentimes you may need to wait till after the new year to get like a true projected number. But again, if you can do some rough math, you can get a sense of if you're grossly under withheld or over withheld. And because again, we are getting close to the end of the year, there aren't a ton of paychecks left. Most people get paid twice a month, maybe once a month. There are a few people that get paid weekly. So you may have a paycheck or two where you can bump that up or knock it back if you're trying to get a little bit more money in your check. But also it's great to know going forward, what you might expect as far as, for 2023, should you be adjusting your withholding? And you don't necessarily, then you won't have to wait till you file your taxes where you're already a quarter of the way through the year. And if you have to bump up your tax withholding, the shorter the duration, the more you'll feel it because you'll have that much less money in your paycheck. So the sooner you can make that small incremental change, the less you'll really probably notice it. But it's also a good time of year to look at your capital gains and losses. Again, because it's been a volatile year in the market. If you have taxable accounts, because again, IRA accounts and Roth IRA accounts, you don't have the ability to take advantage of any gains or losses for tax purposes. But if you have taxable accounts, you should be able to talk with your advisor or go on your platform. If it's an online brokerage, they're usually good at giving you kind of year-to-date capital gains and losses, interest and dividends, and you should be able to get a sense of what your income impact might be there. And again, if you work with a CPA, that's all stuff that they would be able to do. And it's a good time of year if you can catch your CPA before they get into the crazy tax season where they'll be willing to kind of look at that and say, okay, here's some things you might want to do, sooner than later. Or even just to give you an idea, as Marche and I talked earlier, it's always good to know you have a tax bill coming in April, so you can prepare for that and not be so surprised April 15th, you could set the money aside. Okay, and so on the same kind of line of thought here with regard to capital gains and losses, let's try not to forget about tax loss harvesting. So for those of you who are not familiar with the term, it's really trying to utilize any losses in particular investments, could be stocks, bonds, anything within those accounts that may be in the red that perhaps you don't plan on keeping. Obviously we don't buy stocks and bonds for short term typically, unless you're a trader. But if you're buying longer term, you want to evaluate those funds that you own. And if you decide that, you know what, it's time to make a change, then as you say, it's time to make some lemonade and get the tax loss and put it on your return for 2022, which will help reduce your tax liability, or it'll help offset any gains you might have. So if you made a couple good bets and you doubled your money on a stock, this will help reduce the bite of the tax man on that. So you can pair those gains and losses together and figure out what the net result is there, and will ultimately help you to mitigate some of the tax impact there. And just a reminder too, with capital losses, any losses that are over $3,000 per calendar year that exceed any gains you might have, those can be carried forward to years in the future. So those don't expire. So they'll just sit on a line on your tax return, and as you have gains in the future, those tax losses can be applied to future gains. So you don't have to hold the stock and wait to sell it. You can take the loss now, and whatever you don't use on 2022, if we have a strong market in 2023 and 24, and you get some nice gains and you want to take some profit, that'll help cushion that blow. One other thing on this page, charitable giving. This one has changed a bit over the last few years since the tax cut in 2016, I believe, during the last administration, when the standard deduction basically doubled, and a lot fewer people are now subject to itemized deductions or have the ability to take advantage of itemized deductions. So if you're not itemizing deductions, you won't really get the tax write-off for charitable giving. It's not to say you shouldn't give to charity. It's just you won't expect you shouldn't expect money coming off your taxes for doing so, because at the moment for a married couple, it's about $25,000 standard deduction. So if you have the standard deduction, you won't see an incremental difference there. But if you do itemize, you will still continue to get that based on whatever your marginal tax rate is. So, for people who are in the higher rates, that can be 30, 40, 50%, especially when you bring it into Fed and state. So good opportunity to do that. So something that we are all guilty of is signing up for subscriptions that oftentimes we maybe don't use as much as we thought we might. This is always a good time of year to do some house cleaning. I typically try to do this a couple times a year. And an easy way to do this, go through your credit card or your bank statements, whichever you tend to use. If you're a debit card user, you can do the bank statement, but just kind of comb through, do a quick, you can print it out, get a highlighter and say, okay, here are all my subscriptions, and kind of go through and see which ones you probably aren't using or think you can cut. And that's an easy way to free up some cash for the future. And you could always direct that newfound savings directly to your savings account on a monthly basis instead. But it's just an easy way to kind of optimize there and put some money aside. So along that line, given where the market is this year, a lot of people have cash because they maybe are not too excited about putting it in the volatile stock market. or maybe they had a really good bonus year last year, or whatever the case may be. It's a great opportunity now that we've seen such a difference in the interest rate environment to reevaluate your cash situation. So over the last, call it 5 to 10 years even, if you had money in a savings account or a money market account, you're pretty much getting close to zero on it. But the pro of the Federal Reserve deciding to hike interest rates is that now money, particularly in money market accounts, have the ability to get an actual real rate of interest. So as it stands today, a lot of money market funds are paying 3.5% to 4%. And those are short-term government obligation, treasury security type accounts where there's, on a scale of 1 to 10, 10 being the highest risk and 1 being the lowest, these are basically a 1, when it comes to the type of volatility, because, if you're in a money market account, they're supposed to be, dollar in, dollar out. So you're not seeing fluctuations in the net asset value or the share price on a daily basis. And even over the 2008 situation and everything, those money market accounts, were solid. But if you have money sitting at online savings, like at a Schwab or in your checking account or wherever it might be, there's a lot of different types of money markets. So it's a good idea to perhaps take a look at that and say, okay, well, how much money do I have in my checking account? And kind of the old school financial planning rule of thumb was, 3 to 6 months worth of expenses in your checking account for, or your emergency account, kind of figure out what your operating expenses are, any, truly exceptional needs you might have or planned expenses. And then say, okay, what do I have in excess savings? And look to deploy that money where you might get a better rate of return. Because, if you're getting zero on this money, you're not losing money per se, but you are paying an opportunity cost, because if you could be earning 4 and you're getting 0, then that's not great. Also, when it comes to the situation of inflation, which everybody knows everything's costing a bit more, you're losing money not as slowly as you used to in the past, where you're always losing money a little bit if you kept it in a 0% rate of return account. But right now, it's a bit more acute. So I would say a key piece of the asset allocation picture heading into the next year in particular is to evaluate money market opportunities as well as short-term bond funds. I think a great opportunity at the moment is 1 to 3 year high-grade corporate bonds that, again, in the past, even as recent as earlier this year, we're paying 2% at best. Now are in a lot of cases around 4%. In some cases, even a little bit more. So for very little amounts of risk, you can be earning a pretty decent rate of return that a lot of people would be happy with, given the low volatility that it would accompany that. For longer term money, whether it's cash or in a savings account, or if it's money in your 401k, as I kind of alluded to earlier, it's a good time to review your risk tolerance and say, okay, based on my overall plan, kind of my goals that I have, whether it's college, retirement, new home purchase, whatever it may be, how does that fit into the context there? And should I be, perhaps looking to dollar cost average into different types of funds to make sure that my allocation matches what the goal for that money is. So a good opportunity to do that as we head into year end. And I believe this is last but not least, for anybody who is fortunate enough to have enough money where they decide that they want to start giving it away, don't forget about annual tax-free gifting. And annual tax-free gifting allows individuals or married couples the option to give up to $16,000 for individuals or $32,000 to any individual besides spouses, because spouses can transfer an unlimited amount of money to each other at any time. But you can gift up up to that amount to any individual, whether kids, grandkids, your neighbor, whoever you want it to be. You can transfer that money without having to report it on a gift tax form on your tax return. And it doesn't reduce your lifetime gift exemption. And the importance there is, again, this is something that really only affects individuals that are in a high net worth category where you're above the exemption for estate taxes. But this allows for a long-term planning tool or transfer of wealth where you can pass money to the next generation or whoever it might be, whoever your intended heir might be. This is a way of passing more money outside of the estate tax and gifting restrictions. And again, as the slide says, often used by high net worth parents and grandparents. One other opportunity to gift that avoids kind of lifetime gifting and separate and distinct from the annual tax-free gifting is that, for grandparents, as an example, they can pay grandkids tuition. So if they decide, I want to help out and maybe I've already hit my gifting and I want to help out more, they can pay a school directly for tuition that does not get put towards their lifetime gifting. So just another kind of estate planning nugget for anybody there. And I think that concludes what we have here for today. Thank you so much. And I think what the next plan here was to open it up for questions. We've had a lot of good ones so far as we've gone along, but Marcia,
Okay. Well, this is a good one and that we didn't address. Can you talk a little bit about RMDs, having to take your RMDs by the end of the year?
Yes. So RMDs, for those of you who are not familiar, are required minimum distributions. And one quick note, because we were talking about Roth IRAs versus traditional IRAs, RMDs only apply to traditional IRAs or inherited Roth IRAs. Because again, with Roth, you've already paid the tax, so the government has already gotten their piece. But what an RMD is that the government requires individuals over 72 now, it used to be 70 and a half, individuals over 72 have to take a required minimum distribution, and that's calculated based on the prior year's value of the account in question. So if you had a 401k or IRA that was, say worth 100,000 at the end of 2021, that's the value they use. And depending on your age, there's an IRS table, the Uniform Lifetime Table, and it's essentially the government estimating how much the average person your age is expected to live. And they have a divisor there. So, as you're younger, the number is higher because you're expected to live longer. And as you get older, that number goes down. And so as a result, you start off with a lower amount that you have to take in earlier years, and it goes up each year. And you have to take that amount by the end of the year. Otherwise, any funds that are not taken are subject to a 50% excise penalty for any money that has not been taken out. So a big one. Most institutions, even whether they're, again, an online type of situation, or in our particular firm's case, we have a list of everybody who's over 72 or has inherited accounts. That's the other piece. Anybody who has an inherited IRA has to take an amount out every year as well. And they make sure that clients don't miss that because, again, the penalty is so steep that we want to make sure that that's addressed prior to year end.
I don't know if I heard this right, but you had said that inherited Roth IRAs are subject to this, even Roth.
Yes, and the piece of that is that it's not taxable. It's not that the heir has to pay a tax on it. It just has to come out of that account. And the reason is that the IRS does not want multi-generational tax-free wealth accumulation. They want to, at some point, they want to get some taxes on this money again. So the money doesn't have to be, it doesn't pay tax, but like you have a 10-year time horizon where the money has to come out of that Roth now. And so, a lot of these, and again, that's based on, they just changed that rule. I believe that was the end of 2019, early 2020. when that rule changed. It used to be, again, you could do what was called a stretch IRA and apply to all. Now, certain classes of beneficiaries are subject to different timing of how long they have to take it out. So it's the 10-year rule applies to non-spouse bennies, generally speaking. But again, that's something you want to talk to your advisor to confirm all of that, because it depends on your relationship to the person who had the account prior. But the idea is that the government's just telling you have to have the money out of the account. And so that's really how that works.
So I'm going to add in another question about RMDs. This is a great one. If you are still actively working at 72, are you excluded from taking an RMD?
So the answer is that if you are currently contributing to a plan, so if you have a 401k and that's the only account you have, that plan is not subject to the RMD. You can continue to work and not have to take an RMD. But other accounts may be subject to the RMD. So, and that's only 401k plans, so not individual retirement accounts. Oh, my light just went off, excuse me.
No, that's okay. We can.
Yeah, the sensors here. I guess I haven't moved enough. There we
go. That's all right. Okay, a couple more questions here that we weren't able to get to when we were talking about IRAs. Sure. What is a SEP IRA?
So a SEP, again, as we kind of touched on briefly, is a plan. It's a simplified employee pension plan, and it's really an individual's or small employers' IRA plan. It functions very similar for self-employed individuals and people who, again, in small business. I've seen it, in a small attorneys group where maybe an attorney has a couple assistants. He may have his part of it, and then he also contributes for his employees. But it's typically something that's done for an individual, like a sole prop or a small business. And it's a good opportunity for people to be able to put more money in than a traditional IRA would allow them to. Because, again, it's less than $10,000 a year in a traditional IRA.
All right. And then can you talk a little bit about contribution limits for the type of investment accounts, retirement investment accounts? I know there's limits for different ones.
Yes. So there are lots of different limits. So I want to pull up my chart here because they change every year. And as good as I am, sometimes they change quite frequently. So for 2020, because they're indexing up each year. So, and again, these are all things that you can easily look up online, and the IRS has them published. But, and again, because I don't want to give anybody the wrong one, because they. So.
And I will say we are recording in 2022. Yeah, so.
Yes, we are 2022. So for retirement plans, so traditional IRAs and Roths, the regular contribution is $6,000 for anybody under 50. The catch-up contribution for anybody over 50 is an extra $1,000. Okay. For 401ks, 403bs, 457s, which are often government plans, 403bs are nonprofits, teachers often have them, and then SAR-SEPs, which are kind of another funky thing that most people never have. The regular contribution is $20,000 and $20,500 for anybody under 50. This year, again, it was increased from last year. The catch-up contribution is another $6,500. So you can put, for anybody over 50, you can put up to $27,000 into a 401k plan. So a significant amount. And for simple IRAs, it's $14,000 under 50. And for a catch-up contribution, it's $3,000. And as I mentioned before, for SEPs, it really kind of depends on your income for the business. There's certain percentages, and I believe it's 25% of the net income of the business. But again, that's one of those things where you really want to make sure that you have your accountant calculate that for you, because you don't want to, put have an excess contribution into, and so on. That's one that should definitely be done under supervision.
All right. Well, we are getting to the end of our time here. We did have a good question about, can I look back at this recording? Can I watch this again? Because there was a lot of information thrown out here today. Yes, we will be emailing you with a link to the replay of this event, and you're welcome to share that replay with friends and family. And we will let you know that we will post it also on our website and on YouTube, so that should be available. Just give us a little time to let our team put that up there. On behalf of Advice Chaser, we want to thank our speaker and the organizations that have worked with us to bring you this webinar today. Again, thank you, Jeff, for speaking to us. Thank you to our attendees for attending. Lots of great comments. Sorry if we haven't been able to get to everyone. I am saving that, and that way we can reach out to you if we need to address any of those questions that are left.
Thank you so much for hosting, and happy holidays to everybody.
Absolutely. Just a little bit of a note about Advice Chaser. We're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, everyone, have a great rest of your year, and we'll see you at another webinar soon. Goodbye, everyone.
Thank you.